Good evening, ladies and gentlemen. My name is Lee Maingard. I'm a director at Intersect Sectional Title Services. Welcome to our May webinar. This is our fifth one for the year. As you know, for those that have joined us in the past, we try and do a webinar every month and try and be topical and bring information to owners and trustees and whoever wants to join us. And to hear to who we speak to and the topics that we discuss. And hopefully you'll find this evening's topic relevant and informative. I'm joined this evening by Hannes Swanepoel of Zetwin. Hannes, good evening, welcome, and thank you very much for joining us.
Good evening, Lee. Thank you for having me. And thank you to all the owners and trustees for joining. I'm Hannes Swanepoel from Zetwin, and just a quick background on Zetwin. Zetwin is a financial services company that caters to the community scheme industry, sectional title and HOA specifically, and we service, our services range from financial solutions to brokerage all the way to bespoke management services for compliance, etc., for certain estates. It's a privilege to be here, and thank you, and looking forward to this evening.
Thank you, Hannes. Thank you for that introduction. Hannes has joined us in the past. I think it was last year sometime. It was also financial orientated webinars. So thank you again, Hannes, for joining us. Just in terms of protocol, everybody's on mute. If you do have a question or want to make a comment, you're welcome to do that in the chat section. We have about 20 odd slides, so we're going to try and go through them as quick as possible. We're only going to stick around for an hour. We always do that only for an hour. So if we don't get an opportunity to get to the questions or comments, obviously review that afterwards, or you're welcome to email me separately. And if you want to make contact with Hannes, happy to share that as well. Hannes, perhaps you can put your details in the chat section irrespective for those who may want to contact you once we've gone through the session. So this evening, we're talking about financial support for bodies corporate, funding solutions for sustainable scheme management. I think the premise of the discussion this evening is financial management, the pitfalls, the reasons why schemes go into financial problems, why they get in themselves into financial problems, and then also the most obvious ways of staying away from any financial distress that a scheme may find. So we've got quite a few items to go through. I'm going to involve Hannes as we go along. So the introduction to this evening's webinar is, community schemes are increasingly under financial pressure, and that's not necessarily always just to do with how the scheme is managed, but predominantly yes. There are obviously other issues, the economy, interest rates, and those kind of things that also play havoc and put financial stress on owners. But just in terms of sectional title schemes or community schemes, and also we're not excluding homeowner associations. And I'd like to ask Hannes, not right now, Hannes, but I'd like to ask you just now some experience with HOAs perhaps. There are obviously HOAs that also find themselves in financial distress, and also understanding that they don't have the legislative requirements like sectional title schemes have, and maybe just we can have a chat about that in a minute. So most of the reasons or prominent reasons why schemes find themselves in difficulty: aging infrastructure, rising municipal tariffs. We all know the story about the municipal tariffs, the fixed charges that the council, specifically in the Western Cape and also in Joburg in the past, has imposed on owners, and now have to deal with that and the aftermath of that. Escalating maintenance costs, growing levy arrears, big problem. Economic pressure on owners, as I mentioned, interest rates, the economy, decisions that the government make, world wars, all those kind of things have an impact on community schemes at the end of the day. Insurance premium increases. Hannes, maybe we could just quickly touch on that. I think in my experience, certainly since 2021, leading up to 2025, obviously understanding that a scheme does need to do an independent valuation every 3 years, But in the last 4 or 5 years, interesting that we found that schemes have actually had to reduce their replacement values because of the disparity in the increase in insurance premiums versus the actual cost of building costs. You guys do deal with insurance. I'm sure you're going to agree with me. Maybe you can make a comment on that. But that, obviously it does have an impact on schemes, and probably more on if schemes are badly managed, especially when infrastructure is damaging common property, and the continuous insurance claims. But maybe something short from you on that.
Yes, thank you, Leo. I'm 100% in agreement with you. Um, you know, the percentage of just raw material that goes up yearly in terms of, construction material is ridiculous. And more so in Cape Town than in other provinces, funnily enough. And then also what's important to note in regards of or managing your premium is to manage your claim loss ratio, and to
Mm.
do that responsibly, not necessarily claim for anything firstly, and then secondly, your maintenance needs to be up to par, because if you have certain exclusions and you have losses where those exclusions occur in the policy, then that just puts extra financial burden on the entire body corporate. So totally in
Yeah.
agreement.
Yeah, I think the takeaway from that short kind of explanation for both of us is really that, if a building is not maintained, you're going to have insurance claims because you're going to have damage during winter seasons, those kind of scenarios, things that don't get repaired. The insurance company is going to either keep on paying it out, but they will penalize you at the end of the year when they need to renew the policy because of the high claims ratio. I mean, ultimately, and I think this is also maybe just an interesting point just before we move on is, an insurance company is also a business. They also try and make profits. So, if you are paying 120,000 Rand premium a year on your insurance, then that's their income for the year. But as you start incurring, as they start incurring costs or reimbursements for claims, they obviously start losing money. So when it starts reversing, where you have 140,000 Rand claims paid out and they only collected 120,000, well, that's obviously not profitable for them. So, that you are going to be penalized. And I think ultimately all these things kind of intertwine with each other. It doesn't just stand out alone as a separate item. Leg
100%.
yeah, legislative compliance requirements and then deferred maintenance liabilities. We'll have a look at that shortly. So I think that the main question tonight is, how does a scheme remain financially sustainable while protecting property values and owner interests? So we're going to have a look at that through all these slides. So the next slide is in the understanding financial distress in community schemes and common causes. Under budgeting, big thing. We're going to have a chat about that. Under budgeting, it happens often. We certainly, from Intersect's perspective, trying to also educate or help our clients to budget better. And the issue with that obviously is that it's a change, and the trustees are the people that buy into it first because they need to ultimately budget properly. And then obviously the next thing is that you need to go to an annual general meeting and get that budget approved. But we'll look into that shortly. And I want to maybe bring into that the comment of exclusive use areas and how that's budgeted. Artificially low levies. Prior to 2016, I think a lot of the problems that people still experience today has to do with how badly bodies corporate budgeted prior to the 2016 legislation that came in. Hannes, in your experience, you guys also operate in Johannesburg and other areas of South Africa. What has your experience been in that kind of scenario with levies and suddenly now levies having to be either 100% increased or even more?
Yeah, so I think you're 100% correct. Before, the Sectional Title Act was amended in 2016, there was very poor budgeting, or in certain cases no budgeting. But what
Yeah.
also played a huge effect in the budgeting and the levy increases was the COVID period that we experienced, where trustees, majority trustees of majority schemes that I'm aware of, chose to pause any increases in levies.
Yeah.
And what that means is then when they started to increase those levies, they were fairly conservative again, to not go over necessarily like 10%, because anything over 10% sounds extreme to certain owners. And what happens then is you are actually, never catching up in terms of when you pause those increases. And what we find then is, you need like a drastic increase now of 29%, sometimes 40%, sometimes 100% to actually break even. And it's extremely important to know and to be aware. And, there's actually no two ways about it. If you tally up all your expenses, your levy need to service that. And that's the short of it.
Yeah. Yeah, and obviously the reserve planning. Obviously, again, the 10-year maintenance plan is a brilliant example of the changes that have been imposed on schemes and what they need to comply with. So we'll also have a look at that. Delayed maintenance, again, falls into a 10-year maintenance plan, long-term maintenance, those kind of strategic thinking of how schemes should be maintained. High owner arrears, it speaks for itself. The money's not in the bank, you can't incur costs. So that's it's a vital function of the body corporate to ensure that arrears are collected. Unexpected capital expenditure, water leaks and utility losses, insurance excess claims. And obviously we're talking about community schemes as a whole. So, where you have claims where it's on common property, where the body corporate is not covered, or because of bad maintenance management, the insurers decline to pay out claims, and then the body corporate has to foot the bill for the repairs. Municipal billing disputes, water, electricity disputes. Obviously, I think just quickly on that, what we're seeing these days, Hannes, and maybe you can also comment on that, is we're seeing the council doing a lot of estimate readings, and then 3, 4, 5 months later they do an actual reading, and then they reverse all the estimates, and then they go and bill all the actuals on 1 month accounts, and then technically the body corporate gets penalized because now suddenly your consumption goes over into the different tariff fields, and you actually pay more for your consumption. I'm sure you guys are also seeing that as EMAs in the schemes that you're involved in.
Yeah, correctly. It's quite common. It's more common in Johannesburg with COJ, I'm happy to say, than it is in Cape Town.
Yeah.
But it is a national issue. The challenges that we have with councils across South Africa is, I think second to none in the world. And what also happens is, in a lot of cases, there's a lot of disputes in terms of water meter readings where there's faults on the water meter itself. And then that typically comes to a huge bill, at times. And it's, no body corporate has got that cash on hand, which then causes a huge financial distress within the body corporate. So, yeah.
Yeah. Yeah, I think the one positive thing we can say about the city of Cape Town is that they are pretty proactive in terms of trying to modernize meters, smart meters, because obviously they're trying to move away from the human aspect, the involvement of people having to read meters and walk around streets and take pictures and all those kind of things. So I think there's definitely a drive from that perspective, but still we are seeing lots of estimates and then being reversed, and then suddenly you get these huge bills. So I think the summary of that page is, it all leads to reactive financial management and maintenance rather than proactive financial management. But so what's the true cost of deferred maintenance? So deferred maintenance, we had a look on the previous couple of slides. Deferred maintenance will be because the body corporate has major arrears, so there's no financial backing or finances, money in the bank to repair things. There's just bad budgeting. So even while people are paying, the levies are not sufficient to cover the expenses. So, and that will all lead to things like deferred maintenance. And I think ultimately, if there's proactive planning, especially while we're talking about maintenance, like the 10-year maintenance plan, the body corporate should have cash available, even if there is something that they didn't plan for and that suddenly comes through, but they have a 10-year plan and they can strategically look at that plan and understand when they actually need to have the big monies that they need, like the lifts that need to be replaced, those kind of things. So examples would be roof leaks that are ignored, create structural damage. Structural damage means you need to get structural engineers involved. Big roofing contractors need to be involved. Waterproofing delays, plumbing neglect, burst pipes and water losses. I think you see that a lot in schemes where they're already in decline in terms of finances. They just don't have the money to fix. Plumber might come and do something for 2,000, 3,000 rand. The plumber doesn't get paid. They just won't come back again. So, and also the scheme can get a bad name in that regard. Electrical infrastructure aging, transformers, the big ticket items, those kind of things, if they're not maintained regularly. Lift maintenance deferments. I think, I think generally in Cape Town, especially in the older suburbs, like in the Atlantic seaboard areas, a lot of those lifts are probably have been replaced or are being replaced currently or, in the next couple of years, because all those buildings are 40 years plus old. And a lift supposedly only meant to last for 20 to 25 years. So, but a deferment just makes it more expensive. And then also you have the exchange rate problem, because most of the lifts are either manufactured in China or they come from Spain. And then you've got the exchange rate problem, which is also, again, the body corporate doesn't have control over that, especially now with issues around the world where, things that need to get transported via ships and cargo, makes things more expensive. So the consequences are increased special levies, which is the only way that you can really collect money. Not really the only way. Sorry, I'm talking nonsense when I say that. Hannes, you guys, ZFIN, you guys provide those kind of services. Have you been experiencing, a bigger uptake in schemes looking for external funding to deal with these kind of big ticket items that we've kind of touched on?
Yeah, so I think it's consistent, throughout the year, every year. It's, it's dependent on the ages of the buildings and stuff, and nationally, there's always aging buildings. What we do see in terms of uptakes, and I'll take the recent storms that we had in Cape Town as an example.
Yeah.
Those cause quite a bit of damage, and sometimes, especially, referring to roof problems, they cause major issues, and then that, those expenses are, the roof is on the 10-year maintenance plan, but the 10-year maintenance plan didn't make provision for a storm in year 2 of that 10-year maintenance plan.
Yeah.
And then typically the funds has not been collected yet, because it's way pushed up in the timeline, and typically then special levies will need to be raised. And the problem with a special levy in a lot of instances, it still takes time to accumulate that money if it's spread out over, a certain amount of months to make it possible for members to contribute. And the problem that you have then is, it leads to, again, deferred maintenance or deferred repairs, which just increase your costs. So then what we see is often a loan being taken out to tend to the issue, which saves you cost in the long run, and it allows you then to repay that loan via the raising of that special levy, which is a very handy tool for body corporates to kind of bridge these gaps.
Yeah. Just from an interesting perspective, maybe for those that have joined us, let's assume everything goes fine. How soon could a body corporate qualify for, let's say it's R1 million loan? Obviously, there's a lot of things that need to be checked, and T's needs to be crossed and I's need to be dotted, and all those kind of things from your perspective. But in a perfect situation, how soon could a body corp potentially come right with a company like ZFIN, well, let's say for R1 million?
Well, the process, we do need to do it all according to legislation. So before that kicks in, it would be a quoting process, which could be 1 day or 2 days, depending on how long it takes for the applicant to provide the necessary documents, which is only about 3 or 4 documents. So, it's financial documents that typically quite close by. And then as soon as they have that and they agree to it, then they'll call, then they'll require a special resolution. And that can either be obtained through a round robin or through calling a special general meeting. If it's an urgent matter, let's say it's for roof repair, after a storm, then that could be justified to call an urgent meeting, which
Yeah.
would be a 14-day notice.
Yeah.
If it's not an urgent matter and it can't be justified, then it would need to go to the 30-day notice
Yeah.
period because it is a member decision. So it
Decision.
is a
Yeah.
special
Correct.
resolution.
Yeah. Okay. I think also just maybe to just highlight the consequences of, this deferred maintenance, especially on those bigger ticket items, is owner dissatisfaction. And hopefully those members here today have not really had to expose or have been exposed to that. But owner dissatisfaction, I think, is a big problem that comes from that. So the impact of levy arrears, again, obviously the body corporate will budget. The levies need to come in to pay the maintenance, and it could be short-term maintenance as well. In other words, just normal month-to-month maintenance, or if the body corporate actually has planned maybe something bigger, but it's not big enough to go and sit in the MRP. And then also, the MRP side, if people are not paying their levies, they also not paying their maintenance reserve levies, which means that you're technically losing out on two budgets and two income streams from a body corporate perspective. So the effects on the scheme, reduced cash flow, naturally, inability to pay suppliers, which means you can't fix things. There's delayed maintenance. We looked at that earlier. Reduced reserve contributions, which obviously has a long-term, on the 10-year plan, on this. Maybe you can comment on this, where the 10-year maintenance plan, you've got your normal admin budget, which is literally from the first day of the financial year to the last day of the financial year. You're looking at a 12-month period, and that's what you're budgeting for. While your 10-year plan forces you to look at the next 10 years. And, were you using money that you did not plan for, it reduces your income stream, which means that you need to make up for that at some point. Because if you still need to replace the lift in 5 years' time, and you're somehow using that money prior to that time period, you still need to make up for that. So, I mean, the impact of that, you guys, again, is that something that Zetwin would helpful, or what is your experience in the industry from an EMA perspective on the 10-year plan? I mean, obviously we can talk about the 10-year plan on its own for hours.
Yeah, so my comments on the 10-year plan is a 10-year plan should be done by a professional, someone that's got the expertise to be able to plan and to be, point out the, let's say, priorities, or the list of priorities that a building or a scheme needs to pay attention to. And then your reserve fund budget, it shouldn't be the bare minimum according to legislation. It should serve that 10-year maintenance plan. In order to, fund that 10-year maintenance plan and not be the bare minimum, which is very important. And then, of course, if an owner is in arrears and not paying the admin levy, they're obviously not paying the reserve fund contribution, which is, detrimental to the body corporates in the long run, which, leaves them to a large resource, which would often be a loan to, to service that 10-year maintenance plan when a waterproofing project or something comes up that you really can't delay any further. Yeah, I actually also want to add to this effect of arrear levies, if I may, Lee, is, it increases, or it doesn't just take away income streams, but it actually creates another expense for the body corporate. Because if you go and chase those levy arrears, you incur legal fees, which need to be paid, because no attorney is going to work on consignment, and no attorney is going to, wait for his monies and, keep on working. So that's an actual expense, which is very difficult to budget for in your admin levy, because you just can't know exactly what those fees will be. And that puts, again, extra pressure on the paying owners, because that will come out of their pockets.
Yeah, 100%. All right, we are running a little bit behind. So the importance of the MRP, I think we just discussed it. It came into being in 2016 with the Sectional Title Schemes Management Act. And the purpose is for the body corporate to plan financially for future maintenance and capital expenditure. So the capital expenditure would not be the plumber that you call out on an ad hoc basis because the tap's now leaking. That wouldn't be a capital expenditure. We're talking about things that you can, realistically plan for and see that what you need to do. And as Hannes mentioned, using people that are, that are educated and understand how buildings are built and understand how or where to get the costs of how much it will cost to replace a roof, for instance, and then escalating that cost at today's dates, in 5 years' time when you actually do need to incur that cost. So what are the key objectives of the 10-year plan? It prevents financial shocks, special levies as an example. It improves reserve planning. It promotes proactive maintenance. I think that's a very important part of that little sentence there is the proactiveness, proactive. It protects asset value, which is extremely important, obviously, for somebody that, especially if you own it, you want to make sure that your asset grows in value. And one of the best ways is to make sure that your building is maintained properly, and then it improves long-term sustainability. So what should the 10-year maintenance plan or the MRP achieve? Reduce reliance on special levies. Unfortunately, we still find situations like where special levies do need to be raised. Just a general comment, not necessarily in our portfolio. It improves budgeting accuracy. It identifies long-term liabilities. It encourages responsible reserve funding. It improves trustee decision making, and it protects the property values, as we mentioned. I think the key point on that page, crisis management, what it does, it shifts the management of the scheme from crisis management to strategic asset management. And I think that's a big thing these days is the asset management, because that's ultimately what it is. Property is an asset, it's a fixed asset, and that's what needs to be managed, and it needs to be done strategically. And while many schemes still struggle despite the MRP or the 10-year maintenance plan, so the common problems are that the 10-year plan is prepared only for compliance. Hannes, a comment from what do you guys see in the market? I mean, I think that is a big problem in general.
I agree, Lee. So it's, I think majority schemes sadly only, prepare a 10-year maintenance plan so that the audit passes. And that leads to everything that we've discussed up until this point.
Yeah. And then unrealistic reserve contributions. Again, you can find that there's a comment there, political pressure to keep levies low. You can have factions in schemes, people that just don't want the levies to go higher. So the trustees can find themselves in a position where they can't get the budgets approved, or where it's just unrealistic what other owners might think they need to budget it for. Failure for updates plans annually. Again, that goes with the compliance part. That plan needs to be updated every year. Trustees ignoring future liabilities. And then the scheme remains underfunded despite having an MRP. So even though you have that contributions, if you've got an unrealistic reserve contribution, you can put as much money as you want away. If you can't, you need to have a cash flow that shows you that you're going to have the money available in your bank when you need to replace that lift 4 million rand, as an example. The dangers of artificially low levies. It's obviously the risks are inadequate reserve funds, again, infrastructure deterioration, frequent special levies, increased owner disputes, reduced buyer confidence. And again, from an owner perspective, you've bought an asset, you want the asset to grow, you might want to sell it one day and live on it as part of your retirement. The last thing you want to see is your asset being reduced and losing value over time. But I wanted to let's just go back to the emergency borrowing. You kind of touched on it earlier, but you were kind of saying that it's a national problem. It's not necessarily, Cape Town based or Joburg based, but the emergency borrowing part is, we just looked at how long it will take for a body corporate to technically qualify for a loan. If everything went well, it could take more than a month. So I think the context there is that the knock-on effect of not planning or budgeting properly and understanding what you're budgeting for does have major long-term effects on the scheme.
Yeah, 100% agree, Lee. So it's, body corporates specifically are are forced and governed by the Sectional Title Act, which puts certain time restraints on certain decisions, because ultimately it stays a member's decision. So, before 2016, it was purely a trustee decision, so these things could go fairly quickly. But I think rightly so, it was changed to a member's decision, as transparency is most probably the most important thing, or one of the most important fundamentals of community living. So, even in a case of an emergency in 2026, because of legislative requirements, there's no way to get money tomorrow if you have an emergency today.
Yeah. And I think also just the last point there, the important message is that low levies do not equal financial management. I think it's important to understand that, because obviously, people looking to buy or get into property or buy more assets, fixed assets like property, will always have an opportunity before they buy to look at the levy statement of the unit that they want to purchase. And I think sometimes people don't necessarily understand the costs of maintaining a building. It doesn't matter if it's an old building or a new building or 20-year-old building, but looking at a levy statement and seeing a levy, that's low doesn't mean that you're buying into a well-managed scheme. And I think that's quite an important thing for anybody that wants to buy into a scheme.
Sorry, so if I can comment there, Lee, I agree. And one should also, not compare levies, area-wise. Two buildings right next to each other, there's no community that I've come across, not two communities that's the same. They're all unique. So you really should, if you want to buy, you need to look at the entire financials of the body corporate and see what that levy breaks down to, and that will be your guide.
Yeah, it's interesting. Just a comment from my side. It's a question that's regularly asked. I must be honest. The answer is always that I can't tell you, because I don't know what's going on in that building. And although the buildings might be right next door to each other, it doesn't mean that the cost to maintain that building is the same as the cost of maintaining your building that you're living in. So it's interesting that those questions are asked, which kind of indicates that people don't necessarily always will grasp the technical side of how to budget on what you need to budget for a building and the way that the building's been developed. So it's an interesting topic. So just quickly, a comparative: special levies versus reserve funding. So if you're not on the right-hand side, we've got reserve funding. So that's obviously something that we're planning for on a monthly basis, on an annual basis, over 5 years, 10 years, etc., versus having to raise a special levy because you're not doing the part on the right-hand side, which is the reserve funding. And on special levies, it's reactive. It's not a proactive process. It's a financial shock to owners because they, obviously not planning to spend suddenly 20,000 Rand on a special levy versus the predictability when you are planning long-term. It's unpopular. The trustees need to announce it. They need to go to the owners. They need to tell them how much they're going to raise and why they're raising it. And all kinds of questions can come from that. Well, why didn't you plan for that? And then, sometimes the answer is always, oh, but the previous trustees didn't do this, and then it's emergency driven. Well, when you're planning for reserve funding on a long-term basis, it's obviously a strategically planned process. So everybody's aware on a regular basis why they're putting the money away and what your end goal is. And I think that's very important to understand. Funding solutions. Hannes, maybe you can go through this. I mean, there's a lot of infrastructure things here, like the water saving projects, solar and energy infrastructure finance, cash flow bridging facilities. This is more your kind of space. Maybe you can talk us through this for a minute or so.
Yeah, thanks, Lee. So there's various funding solutions available to body corporates. One will find that these solutions are not available from your typical big finance houses, your banks, F&B apps, so ever. It's provided by more niche financial service providers as ourselves, because providing a service or a funding solution to a body corporate is very much a niche market and very specific, because you need to adhere to the Credit Act as well as the Sectional Title Act. So it's a very specialized field. But the there's solutions available to body corporates, for maintenance reserve funding. If your budgeting is correct, you won't need any assistance there. But we've touched on loans for big ticket items that could fall under that. Your special levy finance, that could be linked to a loan. So if the body corporate obtains what I would like to call a vanilla loan, which is, fixed amount, fixed term, fixed repayment, and you're done, that could be directly linked to the income of the special levy that's being raised over, let's say, 6 months. And then the repayment of the loan will be over 6 months. So that makes it very possible for a body corporate to, obtain a loan and to maybe service something that needs to be serviced right away to prevent further cost in the future. Then cash flow bridging facilities, there's various options available. An option that I would suggest here is a revolving credit facility, which a body corporate can obtain and draw funds on as needed when there is an emergency to bridge something just while they're waiting for a certain income. A case like that could very well be when there's a sale and execution going on a unit and they've got a certain expense that, needs to be serviced now. And they know that they've got this money coming in from the arrears on that sale and execution, but they just need to bridge that in the meantime. Then that facility could assist the body corporate in, withdrawing money as and when needed, and then just servicing that facility as soon as they receive that money. Infrastructure finance, again, there's various ways, but typically a fixed term loan would be best and would be the cheapest option available to a body corporate. For anything like solar and energy project funding, you can do that via a typical loan, but there's also rent to own agreements available on any sort of infrastructure such as this. And that brings us to the water saving project finance, which is, it's not that common in Cape Town, but in, East London, Port Elizabeth, Johannesburg especially, water saving and water, let's say, solutions is very much top of mind with every scheme, because they just can't rely on council in the way that we can in Cape Town. And those kind of infrastructure, again, can either be a rent-to-own agreement or it could be a straight-out loan, depending on the cash flow and the unique situation of the body corporate that would be applying for that. And insurance claim bridging finance, again, I would suggest, an easy, flexible solution such as a revolving credit facility where the body corporate can withdraw funds on very short term or very short notice rather, and repay that at any time when that money comes in from the insurance, as an example.
Thanks for that, Hannes. That's very helpful. I think the bottom line of this is that there are other opportunities, and I think from experience, bodies corporate are always looking to save money, especially on utilities and those kind of things. And they always look at how much money is in the bank and what do we need to use it for, which is obviously prudent and that's what they need to do. But I think sometimes they miss the opportunity of going to an external let's call it supplier or a service provider like yourselves, and looking at the options so that they can actually implement something that will save them money over time, which effectively can over a period of time, effectively also pay that loan or portion of that and get the benefit of that. So I think it's an important option to have for the trustees and for owners, because owners can obviously also come up with those suggestions. So what it does do at the bottom, it does spread the major cost responsibility over time, and you don't have that shock effect of a special levy that you have to suddenly pay over 3 months because the body corporate doesn't have funds available. Maintenance reserve funding, obviously that's suitable for roof replacements. So these are obviously your big ticket items, the maintenance reserve replacement plan kind of items, your capital expenditure. Lift upgrades is a very common one. Painting projects also, also very, very common. And then also roof replacements, although I really, from a personal perspective, haven't really been involved in too many of those. And the benefits, I think the one that I highlighted there, it avoids severe special levies. So again, the shock effect of having to go to owners to convince them, they don't have to convince them because the trustees are obviously entitled or authorized or empowered to raise a special levy, but obviously it comes with a whole bunch of things that they need to comply with. They can't just go and raise a special levy for the sake of raising one. But still, let's assume that they jump through all the hoops and they get everything right. It's still a special levy is still a financial burden on people, especially when you're not budgeting or expecting it to come out. Special levy finance. What is it useful for? Emergency repairs. We've touched on that again. Insurance shortfalls, structural failures, municipal compliance works. You might have a situation. Hannes, I don't know. I haven't had any experience like that. Maybe you can, if you don't, that's also 100%. But have you had any experiences where the municipality has written to a body corporate or HRA and written to them to say that they need to comply with certain works, and they suddenly, staring 500, 600,000 rand project in the face?
Yeah, so actually recently I have a very recent example. We are involved with a body corporate that's a beachfront property. So literally the beach sand ends, on their grass. And about 10 years ago, so way before we were involved and before any of the current, trustees or managing agent or anyone was involved, there were certain pillars put into the dunes to keep them in place and to protect it. But that was done by the body corporate. And with the City of Cape Town's current, they call it the beach cleanup, but they're reinstating certain plants and doing all kind of things along the Blouberg area. And then they came across these pillars, and the body corporate was issued, with a note that they need to be removed. But it's 5-meter pillars going down in sand. And it was I think it was 152 of them. So, and it needed to be removed within 2 weeks. And they needed to, there was ridiculous requirements from City of Cape Town that there needed to be a structural, engineering report on it, a plan as to how it was going to be removed, and all of those type of requirements incur extra cost. And there's no point in fighting it, because it was on the City of Cape Town's property, so to say. It was, literally maybe not even a meter into the wrong side. So that's a very recent example that we have that's in City of Cape Town. And other examples that's common is, new developments, Lee, where there were certain shortcuts taken by developers when it comes to the water inlets, the fire extinct or the emergency fire water being on the same line
Reticulation,
as yes, and somehow it was signed off. No one knows, 5 years down the line, but when it comes up, you're going to have issues, and the repair work on that issue is typically excessively high.
Yeah, because the building's already built. I mean, it's it's not like just chopping up open walls and replacing pipes or infrastructure like that. So I can imagine that's quite expensive. So just in these examples, is this where you guys have been approached to provide financing for those projects?
Yeah, so the first example, we are the EMA, the executive managing agent for the building. So yeah, we were appointed 2 months prior to that investigation by City of Cape Town. So it was a very nice introduction. And then the second one is not a unique scenario that I've come across. I've probably come across that about 3 or 4 times this year alone. And yes, that typically would force a body corporate to take out a loan, because that's in no one's budget. It's in no one's planning. You're typically issued with fines on top of it if it's not, rectified. And to rectify such a thing is, for a scheme of, let's say, 200 units, it could be in the millions. So yeah, it's unfortunately a reality within South Africa. And when you go back to the developers, often it's a shell company, and you're going to be just incurring extra legal fees. So cut your losses and fix it. But it's a sad reality.
I suppose in what you're saying at the end is legal settlements. We were talking about budgeting for legal costs, but I mean, how long is a piece of string? And I think that's, it becomes reality that when a body corporate does get itself in a situation like that, and it needs to incur, legal costs and hasn't budgeted for it properly, there is an option to get financing for that. Or the alternative is a special levy. Yeah, so the benefits obviously of the above is that it reduces immediate burden on owners, allows phased repayment, and it protects the scheme, in terms of its operations, that it can continue doing what it's supposed to do, irrespective of what's going on a bigger project. But it should never replace the reserve planning, which, we're hopping on the whole evening. Energy and infrastructure funding. I'm not going to spend too much time on this. We kind of already had a slide that's similar to this. Hannes, you gave us a nice rundown of financing for those kind of things. But I think just for the purpose of the evening, the popular projects, and these are projects that are some of them are they kind of come and go. Solar systems, we find obviously some schemes are just not built for solar systems to be put in, solar panels and those kind of things. It just doesn't become a viable or financially viable project or installation. LED lighting, very common. Water meters, common because people want to get rid of, having that water expense in the budget and effectively influencing the levy. Pressure management, backup power systems. Also, it was a hot topic. It seems to be going away a little bit, but forward planning, I think it's probably a good project to still consider and plan for. Boreholes was also a big thing many years ago. When we had the whole water issue in the Western Cape, boreholes, saw guys all over the place, creating boreholes and water storage. And then the long-term benefits reduce operating costs, lower municipality dependency, which is obviously a big thing as well. Probably more so in other areas in the country than in the Western Cape. Hannes also touched on that. Increased property value keeps on coming through the whole evening through the slides, and then improved the sustainability of the scheme in general. Better budgeting practices. I mentioned earlier that we probably wanted to just touch on this. So, unless from a budgeting perspective, you guys are on both sides of being EMAs and also from a financing perspective. When you guys are giving financing to schemes, 100% you're looking at the budget, and you're probably picking up the issues there. And we also looked at the historical kind of issues in the past prior to 2016, the way that bodies corporate budgeted. They wanted to keep those levies low. Now they have imposed regulations that they need to comply with. Maybe some comments on the budgeting perspective there from you.
Yeah, Lee, I think the topic that keeps on coming through is keeping the levies as low as possible, and it's still a reality in today. So often we get approached for funding for whatever reason, and one of the first things I look at is the budget. And if your budget is not sufficient and it's not servicing the building, then there's I can't approve you for any sort of funding, because there's no point in funding something that's not budgeted correctly, because that is where the crux is. That's where your issue starts, and you'll never get rid of that issue if the budget isn't realistic. So there's no point in keeping a budget low, but then deteriorating having an implosion of value over time, let's say 10 years from now. Ultimately, it would lead to much bigger losses than the perceived view of high levies makes a property unattractive. I don't think that's the case.
Yeah, I agree.
So it really is, a budget is easy in my mind. It's looking at your expenses. It's looking at, exactly like you've said, at your historical expenditure trends, looking at inflation, looking at, the political stance of the world, because that will kind of guide you in your inflation calculations. And, plan for municipal tariff increases, and those will come. Plan for 1 or 2 extra fees that the city of Cape Town will implement now that they have certain rulings against them, because the money will still need to come from somewhere. And if you divide that, then you get your budget, and that's really that is your only guiding light in terms of setting up your budget, and that will determine your levy. And if that forces a body corporate to increase their levy by 30%, that might very frank opinion is you don't have a choice.
Yeah. No, absolutely. I mean, I always say this when when the opportune time is there, is that the money can only come from one place. Even if you get external funding, you still need to pay it back, and the only people that can pay it back are the members in the scheme. So, I think also a comment from my side is that budgeting shouldn't always just be left to the trustees. They take the brunt of it, and obviously the managing agent. But owners should give it the time of day that it requires. It needs to be analyzed and reviewed, and questions should be asked. And if it was only 8% and it should probably be 10, then people, they should accept that it should be 10%. Not rather try and argue for the 8%, hoping that it's not 10%. Those kind of things. So I think the budgeting thing is a very interesting topic in general. Maybe we can do a session about that separately. But the budgeting thing is an extremely important part of a body corporate, and I mean, there's no need for me to emphasize that. Cash flow management strategies. So what does it do? It improves operational stability of the scheme. What's important to make sure that the cash flow management is, it provides the stability. One of them is the aggressive arrears management. We touched on that as well. Monthly financial reviews, early identification of risks. That would mean that people need to walk around, trustees need to walk around, or they need to bring in professionals to give their opinion about something, like a structural thing. Not everybody is a structural engineer. As much as what trustees put up their time and want to be involved, and which is fantastic, sometimes you just need to bring in the experts to have a look at something for you and give their opinion. And then, that could either go into nothing, or it could roll over into something that you suddenly need to start saving money for. Utility monitoring is a big thing. Having to deal with owners that think that they're being charged too much for electricity specifically, and then also water. Dealing with utility meter reading companies. That's a very important aspect of this is not always just, this is more managing agent kind of orientated, these things. And then strong cash flow reduces borrowing dependency, owner disputes, and then obviously operational instability, which is what we want to avoid at all times. So the role of trustees and managing agents: trustees should understand financial statements. I mean, that's critical, I believe. Review MRPs annually. Again, Hannes, you mentioned using qualified people. We have infrastructure consultants available to do these things, on behalf of bodies corporate and the trustees. And I think, holistically, body corporate should see that as a positive, that somebody externally that has the expertise and the knowledge can actually put forward a 10-year maintenance plan for body corporate and annually update it. And it obviously helps them to make long-term decisions, not these short-term decisions that we're trying to avoid, like having to raise special levies, and sustainability coming up again. And from a managing agent perspective, provide strategic financial guidance, monitor reserve adequacy, improve collections, and assist with funding assessments. Funding assessments, like having you guys on ZFIN on this webinar this evening is providing an option for schemes that we obviously manage as a company. So there's a lot there. Just two little real world examples. Very simple one: deferred maintenance crisis. We talked about that at the beginning of the evening. Levies are kept artificially low for many years. There's no reserve funding. Suddenly there's a major waterproofing failure somewhere, and the waterproofing has to be done. Waterproofing, we know, is not a cheap kind of repair. And then suddenly the trustees don't have an option but to raise a special levy. And it's obviously, suddenly you have owners that potentially fall into arrears because they've got used to not putting away sufficient monies through their levies into the body corporate coffers. And we all kind of know how it works is, the more money you earn, the more you kind of spend. Hopefully, we don't, but that's a kind of a general human tendency. And if you're spending less on something, then you don't get used to spending more on something. So I think it happens. And then obviously, main thing is deferred maintenance becomes more expensive later. And then the reverse of this is proactive financial management, where the annual 10-year plan is reviewed, proper reserve funding is made provision for. There's planned infrastructure upgrades, solar investment reduced costs. So obviously, not all schemes would qualify for solar installation because of the size of the roof or the direction that the roof points, or those kind of things can be very technical. And then stable levy increases over time. Hannes, I mean, your view on this, we get situations where buildings have, healthy kind of reserves at the end of each financial year. And then people don't want to increase levies. And, certainly my advice is always, even if you just increase the levies by 2% or 3%, what you're doing is that you are not allowing people to get used to not having an increase, because ultimately what will happen is you will find a situation in 2, 3 years' time, if you have any increased levies, that suddenly needs to go up by 15, 20, 25%. And that's also a shock factor. And then you can't go back and reverse the decisions that were made 2, 3 years ago.
100%. And it also keeps your, I think what you alluded to, your future increases manageable, which, creates a friendly environment for everyone involved.
Yeah, no, 100%. So we're almost at the end. So the key takeaways: so sustainable schemes require proactive maintenance, realistic budgeting, proper reserve funding, strong governance, and that governance comes from the trustees and then obviously the help from their managing agents, effective arrears management, and strategic use of funding solutions. And financial sustainability protects owners, property values. We've talked about that this evening, and the long-term future of the scheme. So in conclusion of tonight's webinar, community schemes are no longer able to rely on reactive financial management. Yes, they can, but it's expensive and it will cost them a lot more. And then schemes that will thrive in the future are those that plan ahead, fund responsibly, maintain proactively, and manage strategically. Hannes, I want to thank you. It's 6:27. I see that we don't have any comments in the chat section. Not sure if that's good or bad. Wait, there might be a chat here. I think that's yours. Yeah, so we don't have any comments. If there's anybody that's here this evening that would like to ask a question afterwards, you're more than welcome to email me. I can always put you in contact with Hannes or his company. Thank you very, very much for your time. And the recording will be sent out in the next couple of days with this slide. So we'll send that out to everybody that registered for the session. Hannes, for you, thank you very much for your time. And for your inputs. It's most valuable and very interesting to hear what you guys are also up to. So thank you very, very much for your time as well.
Thank you, Lee. It's been a privilege. Thank you, owners. Thank you, trustees. Have a lovely evening.
Thank you, everybody. Yeah, and like I said, you're welcome to email me. Otherwise, hope to see you at our June webinar. Have a good evening.